All right, well, welcome to chapter 15, and I apologize, I have to do this recording. Yeah, I'll post about it on the website shortly. So yeah, welcome back to the second half of the class, and here we go, chapter 15. And before I get into that, hopefully you saw the announcement about the group project. The variables and the template were released last week. I made sure that was done last week in case those that desired to get a start on it wanted to. So please do so, reach out with any questions and follow the instructions accordingly. So chapter 15, we're going to move into budgetary planning. So on my screen, we've got the Wiley PowerPoint slides, and I'll just walk through and add some verbiage for it. And then you can always follow up with questions either through email or in our live class each week. All right, so this chapter is all about trying to understand the essentials of effective budgeting, various components of budgets, how to create budgets for sales, production, direct materials, and other components, as well as in a cash budget and a budgeted balance sheet. And then we'll look at applying budget principles to non-manufacturing companies. So the bulk of this chapter is looking at manufacturing, and then how do budgets translate to those that are typically performed around service or potentially retail. So the first one we'll talk about is the effective budgeting, the components of the master budget. So the budget is a document that management creates for a specified time period. Typically, for a year. I think we talk about that later on. Typically, it's for a year or a period of time, 1 year, 2 years, 3 years, 5 years, 6 months, typically a year. It's a way to communicate what objectives you've agreed upon for your organization. So it looks at sales volumes, expense targets, etc. It helps promote efficiency in the fact that you set budgets, set limits as far as what individuals, managers, employees, whatever it might be, have to spend. So therefore, you can kind of keep an eye on it and hold people accountable. So therefore, it's considered a control device. Typically, when we look at different types of accounting, historical accounting data on any past revenues, costs, expenses help us. So knowing what our past experience have been can help us determine the future. Typically, there's an accountant involved for representing the management's budgeting goals, depending on the size of the organization, the complexity of the budget, what kind of experience you may need. And the budget is typically the responsibility of management, and that creates a way to measure performance by comparing your plan, your budget, with your actual productivity or activity in the organization as time proceeds. Now, some of the benefits of budgeting is that you always want to plan ahead. You want to talk to your managers, get their perspectives on what's possible, what's achievable for sales, what's required for expenses to achieve those sales. And it's very helpful to include all the various levels of management. Budgeting also helps provide objectives, these sales targets, these expense targets, these production targets, whatever that might be. So it provides defined or definite objectives, which then you can hold people, staff, employees accountable for and measure their performance accordingly. Budgets also, when you add monthly or quarterly or seasonality fluctuations in budgets, you might create a budget for 12 months, but know that maybe most revenue comes in 3 months, but yeah, you have expenses all year. So you can play with your seasonality of revenue and expenses separately. And by monitoring your actuals against your budget, it can help you identify early potential problems. It helps coordinate your different activities of the business. So say you have a marketing team, a sales team, a production team, a finance team, whatever you have, it helps coordinate all the moving parts. So depending on the growth of, say, your staff to produce, maybe you need growth in HR to support it, for payroll, for hiring, firing, performance management, union negotiation, whatever that might be. So by budgeting all those details with input from management, it helps feed each other as far as the various activities of the business. Budgets also allow people, management primarily, and anybody that should have access to it, awareness of the overall operation. So maybe, the marketing manager sets his budget or her budget, but they are aware of the budgets of the other departments and how they kind of interrelate to each other. And by having that set budget, it can motivate personnel to meet their objectives. So maybe part of their salary is tied to objectives. So maybe 3% of their salary is only achieved if they hit a certain goal, or 10%, or whatever that might be. So by having something documented, agreed upon, passed, approved, etc., it'll hopefully inspire them, sorry about that, to meet their objectives. So a quick question then, which of the following is not a benefit of budgeting? So we have management can plan ahead. Well, that definitely is. An early warning system is provided for potential problems. We talked about that is because you can measure your actuals against it. C, it enables disciplinary action to be taken at every level of responsibility. Not really. That's more of an HR process. And D, the coordination of activities is facilitated. So yes, it is facilitated through the budgeting process. So C is the right answer, being not a benefit of budgeting. So we're talking about effective budgeting. We want to have some essential standards in place within the organization. So you want to have a structure that has proper authority and responsibility for all the different parts of the business. So if you have a production manager or production lead and then production managers for different areas of the business, you want to make sure that they each have authority to run their departments. And that might be ordering supplies, making plans for raw or work in progress inventory, hiring and firing staff accordingly based on the skill sets they need to meet their objectives for their part of the business. So you want to make sure that they have the power, the authority to run their part of the operations. And very often effective budgeting does use research and analysis to help create more realistic goals. So it'll look at history, it'll look at competitors, it'll look at what's possible, achievable, etc. So based on that data that you have, whether it's your own or whether it's industry standards, it helps you create more realistic goals. Is it realistic to achieve a 30% growth in sales in selling t-shirts? Maybe not. But if historically, and you have an organization that's growing in the tech, say, and tech's coming more in demand for more people working at home, and history, and not just history, but there's evidence that there's a justified growth targets to those extremes, then it helps you set something more realistic. Effective budgeting also, you want it to be accepted by all levels of management. So right from your supervisors, your foremans, your leads on the ground, working with the staff and the employees every day, all the way up the chain, however many levels that might be, 1, 2, 10, whatever it is, right up to the president and CEO, and ultimately your board of governors if you have one. So you want it to be accepted by all levels of management for that buy-in, for that sense of ability to make a difference and help achieve the objectives. And as I said earlier, most common budgets are 1 year. Very often you'll have a monthly or quarterly budget, so you can manage it on a regular frequency. And you might have different budgets for different time periods. So maybe April, May, June are busy months, but maybe January, February, March are not. So you can have different budgets for different time periods. But you also want a budget that's long enough to achieve specific goals. So maybe if your business has a 2-year life cycle for whatever product you're making, selling, etc., maybe you need to have a budget for that whole 2 years. Or if you're in a startup business, you're a new car manufacturer, maybe it's a 10-year budget, looking at building factories, building prototypes, getting approvals, getting those first sales out the door, whatever that might be. So you have to make sure your budget is long enough to actually achieve some goal. However, the next bullet we talk about, it needs to be short enough for reliable estimates. So if you can't, put a number on it that's reasonably accurate, then maybe you shouldn't go too long. Like if there are too many variables, it says in 3 years, I don't know what the cost of my hydro is going to be or how many staff I'll have, whatever that might be. You can make some assumptions, but you don't want to go so far out that your assumptions continually to build upon each other and then they're completely unrealistic. And the last thing is, in many companies, they may use what we call a continuous 12-month budget or a rolling 12-month budget. So every month that passes, you add another month on the end. So you always have 12 months of activity planned. So a rolling 12-month budget is very common, the terms, and widely they teach it using the word continuous. So you always want to base your budget goals on past performance. I think I mentioned that earlier about historical data. So you'll collect information from the various units of the business. And typically it takes months before year end. So if your year end happens to be December 31st, you probably start planning for it in the summer, June, July, August, because by the time you get through all the process of an effective budgeting process, it could take you 3 to 8 months or longer, depending on the complexity of your business. And what you typically do is with the budget is created with the sales forecast in mind. So you look at potential industry sales, what's your expected share? Are you coming up with a new product that you think will have a certain, impact, good or bad? So you always want to start with that sales forecast. When you're looking at your sales forecast, there are a number of items that you need to consider. And these are some of them. You need to look at the economy, what's happening in the industry. Are there any studies looking at your sector or segment of the business in order to help give you guidance? What kind of advertising and promotion might be out there that might drive customers to you? What was your previous market share? What if you change prices? How will that impact your customer ability to purchase, perhaps? And are there any technological developments? And then related to all of this, you want your sales personnel or your top management within the sales team to be part of that sales forecast development. So if you have a sales manager and a bunch of sales persons, you want to bring them in to say, what do you see? What do you hear from your clients and your customers or our customers, et cetera? What's achievable? And again, that helps them buy into the objectives. And that speaks to the word of participative budgeting. So that not just for sales, but for other areas too, is that you want every level of management to be invited to participate. And by doing so, you'll typically inspire more performance, better performance, and you'll discourage, what they're saying, discourage additional efforts, which means people won't try to say something that's inaccurate or inappropriate or super conservative. However, just a sub note on this page, in smaller companies, typically the budgeting process is very informal. So if you have a small company, maybe 3 or 4 staff, and maybe you only run $500,000 a year, whatever business is, maybe it's a small restaurant only running a few $100,000. So it's very informal. You just throw some numbers down and away you go. But in many larger companies, you typically have a budget committee. So that could be representatives of different parts of management, different teams. It could be representatives from your board. And they're all there to help create the budget. So the more accurate budget estimates are attained when you include lower level managers. So, the foremen, the supervisors, those people on the ground, if you do include them, you typically have a more accurate picture of what's possible. And also by involving them, it's typically considered a fair process because they were included to develop their objectives. Now, one of the couple downfalls is it can take a lot of time and be super costly because you're using a lot of people's time if you have a full participatory budget process. So if you include, say, all of your management and you have 100 management and you have 5,000 employees, I don't know whatever that might be, it could take a lot of time to kind of get all those people together, consolidate all the information. So it can be considered a significant disadvantage. And what we talk about here is budgetary slack. So say I'm asked a question, what's achievable for sales? I think I can get 10%, but I'm going to tell them I think 3% is reasonable. That's what we call budgetary slack. So when you're close and you're being held accountable to those targets, maybe you don't want to say what you really think is possible. And on the flip side, for expenses, if they say, what do you need to run the business? And I say, I need $50,000 in marketing budget. But realistically, you know you can do it for 20. So you buy yourself some space. And that's not always good either. It doesn't give the business really appropriate information for planning. So just a picture of how the flow of data would work under participative budgeting is it typically starts at the bottom. So you have these different department managers will roll up to maybe plant managers or whatever, or region managers, who then will roll up to a VP, up to the president, up to the board, et cetera. So this is just kind of depicting what that could look like. So some of the differences between budgeting versus long range planning has to do with, the time period. Budgeting is typically, shorter, 1 year, months, couple of years maybe, versus long range. You might be talking about where do I want to see myself in 10 or 20 years? In the budgeting world, what's the emphasis? The emphasis is, very specific. What are the targets right now versus long range? What's the target in a long period of time? Maybe your target long range is to produce 1 million cars a year. But right now, your budget is to do, 10,000 this year and 100,000 next year, whatever that might be. And then a budget is typically very detailed. You'll have personnel by department, your overhead, your rent, your utilities, all those different details. But in long range planning, typically you run, the closest 100,000 or million, depending on the type of business. So different levels or scales represented. So a quick question here, the essentials of effective budgeting do not include what? What does it not include? Top-down budgeting, management acceptance, research and analysis, or sound organizational structure. Well, it does have sound organizational structure. It does have research and analysis. You do want management acceptance, but top-down budgeting probably won't get management acceptance. So A is what I would suggest is the answer. So now let's jump over to the master budget here. So the master budget looks at all the interrelated budgets. Okay, so you might have a budget by department, might have an operating budget, a financial budget on how you cash flow the business, et cetera. So we've broken it down here. So operating budgets will result in a budgeted income statement, and they typically talk about what your sales targets are and what kind of personnel you'll have. The financial budget typically looks at, okay, what do I need to operate the business? What kind of capital investment do I need? How am I going to fund this cash? Because cash, as you know from your accounting courses, is different than accrual accounting and what the financial accounting statements might look like. And by looking at that, it could create a budgeted balance sheet. So based on timing of AP and when you're paying your vendors, when you're collecting from customers versus when you record those revenue and expenses, that'll help determine your balance sheet. So will you maintain a positive cash balance? Will you maintain positive equity? And typically financial budgets focus on cash resources needed to fund the operating, because there will be timing in operating, plus any capital expenditures. So looking at the different components of a master budget, the financial budgets, operating budgets at the top, you'll have a sales, you'll have production, you'll have all your direct costs, materials, labor, and manufacturing overhead. Then you have all your selling team and administrative expenses, and that creates your budgeted income statement. Your financial budgets are represented at the bottom of the screen, being your capital expenditure budget, your cash budget, which is driven both by capital and by your budgeted income statement. And that can result in a budgeted balance sheet. So a little question here. Use this list to complete the sentences that follow. So we've got 6, I believe, here. The first one says, which from the list is a blank shows potential sales for the industry and a company's expected share of such sales? We're all talking about sales, so it's a sales forecast. Next one says a blank are used as the basis for the preparation of the budgeted income statement. So the operating budgets are used as the basis for preparation of the budget income statement. So the operating budget. Next, We'll talk about what is the set of interrelated budgets that constitute a plan of action for a specified time period. And we called that the master budget just a moment ago. So the master budget is all the interrelated budgets, whether they're finance or capital or cash, whatever that might be. And we mentioned this again, long-range planning identifies long-term goals. It looks at strategies to achieve those goals and develops policies and plans to implement those strategies. Lower level managers are more likely to perceive results as fair and achievable under, and we've been talking about this for the last 10 minutes or so, participative budgeting approach. They're included. It's an inclusive approach. And the last item left to talk about financial budgets focus primarily on the cash resources needed to fund expected operations and planned capital expenditures. So financial budgets look at all the cash needed to operate the business. The next part of this lesson looks at how do we prepare budgets for sales, production, and direct materials. So typically on the sales you'll start with, it's the first budget prepared, and it's derived from your sales forecast. Some organizations will do it backwards. You'll develop your expenses required to operate and then come up with sales afterwards, but it's very uncommon. In the not-for-profit world, a little more common perhaps. But then you'll derive that budget from your sales forecast, and it's your management's best estimate of revenue. So they look at what's happening, talk to your sales personnel, what's your share of the industry, et cetera. And every other budget typically depends on the sales budget. So if you think you're going to sell 10,000 widgets, 10,000 pieces, therefore you have to produce 10,000 pieces plus whatever you want to keep in inventory. So you need to start with the sales volume and sales price, and then that sales volume helps drive the other components of the business. So a little example here, Hayes Company, we expect 3,000 units in the first quarter, 500 unit increases in each succeeding quarter. At a sales price, we'll just say it's $60 all the time. So we can see our expected sales units over each quarter, 3,000 increases by 500 for a total of 15,000 for the full year. At a selling price of $60, we have a total sales budget of sales revenue of 900,000. And you can see it's growing from 180 to 270 per quarter. So now we have our sales units expected and planned for. So we can move over to our production budget. So we have a sales budget. What do we need to produce? So our production budget shows that how many do we need to produce to meet the anticipated sales. So we have that as our start, our expected sales. However, we need to add in what's the desired change in our ending finished goods inventory. So typically businesses will always have some produced goods in inventory. So when a customer calls, here you go, I don't need to wait for it to be produced. And you always want to have a realistic estimate of that in inventory. Where are you going to keep it? Is it possible to produce that, whatever that might be? So in order to get a required production of units, we will look at our expected sales units plus our desired ending finished goods, less what we started with. So a little example here. We think that we can meet future sales needs with an ending inventory of 20% of next quarter's budgeted sales volume. So we just restated here our expected sales units by quarter, 3,000 increasing by 500 each quarter. Our desired ending finished goods are 20% of the next quarter. So 20% of 35, 700, 20% of 4,000, 800, et cetera. So our total required units would be 37, 43, 49, and 5,500 units. However, let's assume our beginning finished goods units was 20% initially. So we'll assume that we started with 600 and that we always want 20% of the, of the next quarter sales. Yes, of the beginning, that works, sorry, of the beginning. So it's these numbers right here, 800, 900 down. So for our production units then, for the first quarter, we need to produce 3,100. We're going to sell 3,000. The extra is going to go to inventory to help support the next quarter. And therefore, over the 4 quarters, we want to produce 15,400 units. Now that we have our units, we can move over to our direct materials budget. So we look at our units to be produced times the direct material units per unit of unit produced equals the direct material units required. Okay, so say it takes 2, 3, 4 units of direct materials to produce 1 unit of good. You need to multiply those units of good by that factor. And similarly, just like production of sale units, you might have a desired ending direct material units. Like you always want to keep that stock available so you can keep producing and never run out. Once you've created that one, that'll determine the direct material units to be purchased times the cost per direct material unit will equal the cost of direct materials purchased. Pause. I forgot to pause, that's okay. So now let's look at an example where each unit produced requires 2 pounds of raw materials, which costs us $4 each. We want to maintain an ending inventory of raw materials equal to 10% of the next quarter's production requirements. The desired ending direct materials amount is 1,020 pounds for the 4th quarter of 2022. And I think we show that in a moment. Yes, we do. And so we want to prepare a direct materials budget. So we have a little table up here. We start with our units. This all reconciles with the previous slides. The direct materials required, it says 2 pounds each. So we'll multiply those by 2. So the total pounds needed are accordingly. Our ending direct materials, we always want 10% of the next quarter. So we want 720 left, 820 left, 920, etc. So our total materials required for each quarter, and quarter 1 would be 6,920, etc. And let's assume we started with 10% at the beginning of the quarter, so we'll subtract the opening. So for the total amount of direct materials purchased required for quarter 1 will be 6,300. And you'll notice that slightly exceeds the pounds actually needed or consumed in that quarter. Then we can multiply that direct materials purchased by the per unit cost of $4, and we can get our total direct materials cost. You can see it growing over time up to $124,800 for the full first year, or for the year of 2022. All right, so let's look at this example here. Soriano Company is preparing its master budget for the year. Relevant data pertaining to its sales, production, blah, blah, blah. Sales. Sales for the year are expected to total 1.2 million. Quarterly sales as a percentage of total are 20, 25, 30, and 25%. So they do have some seasonality. It's not equal. The sales price is expected to be $50 per unit for the first 3 quarters, and then we'll have a sales price increase for the 4th quarter up to 55. Sales in the first quarter of 2023 are expected to be 10% higher than the budgeted sales for the first quarter of 2022. All right, production. Management desires to maintain the ending finished good inventories at 25% of the next quarter. So remember, we always want to end our inventory based on what we plan for the next quarter. And our direct materials, each unit requires 3 pounds at $5 per pound. And we desire to maintain raw material inventories at 5% of next quarter's production requirements. And assume the production requirements for the first quarter of 2023 are 810,000 pounds. So we're asked to create the sales, production, and direct materials budgets by quarter for 2022. So again, we want to start with the sales budget. So you can look at our seasonality here of unit sales, 1.2 million for the year, and you can see, lower in year 1 or quarter 1, higher Q2, higher Q3, and back down in Q4. At our selling prices accordingly, 50, 50, 50, and 55. Our total sales revenue then would be 61,500,000. Our our production budget by quarter, we looked at our expected unit sales, so 240,000 for quarter one, which reconciles with this sales budget. Our desired ending finished goods are tied to the next quarter, 25%, 25% times 300. Total required units quarter one is 315,000 less the opening, which we will assume is 25% of the 240,000. You can see the notes on screen here. So our total required production units will be 255,000. So we'll produce 1.2 million and 6,000 extra in the year. And that ties in with the sale of 1.2 million expected. So we'll have 6,000 left to kind of carry over for Q1 of 2023. Then we can move to direct materials. So now we look at the units to be produced. So 255 for quarter one. Go back a slide, ties with the 255 for quarter one. 3 pounds per unit. Total pounds needed, 765. Desired ending product, we said 5% of the next quarter. So 5% of the 945, you can see it here. And we're told what to expect for quarter four. And our beginning, we'll assume 5% of the beginning. So 5% of the 765 was 38,250. So our total direct material purchases in quarter one is 774 at $5 a pound is 3.87 million. And you just extrapolate that out. So our total direct materials purchases of 18,101,000. So what was our sales? 61 million. So about 30%, not bad. So that's kind of the direct sales and materials budgets. So let's move on to labor. So we're going to talk now a little bit about direct labor, manufacturing, overhead, and selling administrative expenses, and then the resulting budgeted income statement. So when we look at labor, it's similar to the sales side. You have in that you have quantities and numbers. So when you look at labor, you have hours and the cost per hour, and multiply the two, and you'll get your total direct labor cost. Stepping back one step further is you look at units to be produced. You hopefully know how many hours it takes to produce that unit times the labor cost per hour will give you the direct labor cost. So then depending on your business, you might know A times B already, or maybe that's what you need to find out. So a little example here, looking at the units to be produced, 31, 36, 41. So that ties in with the earlier slide near the beginning of the lesson, sales. So this Hayes company, and we're told 2 hours of direct labor are required to produce each unit of finished goods, and our hourly wage is $10. Somebody hasn't updated that in a long time. So we look at our units, 3,100, 2 hours each, 6,200, $10 per hour, $62,000 for quarter one. And therefore, our total over the 4 quarters would be 308,000 direct labor. So this is actually producers, not salesmen, not your finance admin, HR, whatever that might be. Okay, that's direct labor. Moving on to manufacturing overhead, typically what this does is help distinguish between fixed and variable overhead, because sometimes you might have electricity costs based on how many hours you run the business and how many machines run versus your building space if you own it, or if maybe you have fixed rent, 50,000 a month. So we can identify the difference between those. So we have an example here. Hayes Company expects variable costs to fluctuate with production volume on the following basis per direct labor hour. So we have indirect materials, indirect labor, utilities, maintenance, and therefore for 6,200 direct labor hours, which is what we calculated for quarter one, to produce the 3,100 units, budgeted indirect materials would be 6,200 direct labor hours times 1. Indirect labor, $1.40 times 6,200 is 8,680. Okay. And we're not calculating utilities and maintenance yet. Okay, we'll do that in a moment. Hayes also recognizes that some maintenance is fixed and the amounts reported for fixed costs are assumed. So we're asked to create a manufacturing over budget. So the next slide here shows you what that manufacturing budget, overhead budget might look like. So from the previous slide, we bring in our direct labor hours because that's one of our drivers. And then we always start with our variable costs first. So we'll list the 4 that we were told: materials, labor, utilities, and maintenance. And they're all rated per hour. So you just multiply the per hour times the number of hours for that quarter. And then fixed costs, we're just given a bunch of info. There might be supervisor salaries, depreciation, et cetera. And then we can add up all those manufacturing overhead pieces, all the variable costs, the fixed costs, and you can see that it does grow over time from 57.1 up to 246.4. And just for awareness, your manufacturing overhead rate per direct labor hour, you can take your total budgeted manufacturing overhead, divided by your total direct labor hours for that quarter or year in this case. I would say it's about $8 an hour per direct labor hour for all the overhead. It's good to keep an eye on those indicators. Then we can move on to selling and administrative expenses. So it helps us project our anticipated operating expenses. And again, it distinguishes between fixed and variable costs. So we're given an assumption, variable expense rates per unit of sales. Our sales commissions of $3 and freight out to send it to our customer of $1. And Hayes expects sales in the first quarter to be 3,000 units. And fixed expenses are assumed. So again, we have our budgeted sales, not production. We have our variable costs. We have our fixed costs, so advertising, sales, et cetera. So our total selling and administrative expense is 42, growing to 48 for a total of 180,000 over the years. Hopefully you can open one of the Excel files and just see some of the tables and do some of this work on your own too. And we'll do, yes. All right, so the budgeted income statement then is the end product of all your operating budgets. And it helps identify, are we going to be profitable or not? It also helps support any evaluation of the company, like what's our ratios look like, what's our profit margin, what's our net income, before taxes as a percentage of sales. And so now we pull in all our operating budgets, our sales, direct materials, labor, overhead, selling, and admin. So then, just as an aside here, we want to find the cost of goods sold. We must first determine the total unit cost of producing one bicycle seat. So we have an example here. Our direct materials, labor, and overhead. So you can find these illustrations in the text. So our 2 pounds of direct materials at $4 a pound, or 2 hours of direct labor at $10 per hour, or 2 hours of manufacturing overhead at $8 an hour. Our total unit cost is $44. Next is we can determine the cost of goods sold by multiplying the units sold times the unit cost. So 15,000 units times $44. So our COGS, our cost of goods sold in this case, would be 660,000. So popping it over to our draft budgeted income statement, we can show our sales as in the book, 900, cost of goods sold, gross profit, our selling and admin that we've calculated, and then we're told an interest expense, et cetera. So you can see this in illustration 15.3, it says. And we have a budgeted income statement. So now a quick question. Each of the following budgets is used in preparing the budgeted income statement, except what? Sales budget, we said yes. Sales and admin, we said yes. Direct labor, we said yes. So C, capital expenditure, is not part of the income statement. It helps feed the cash flow and therefore the budgeted balance sheet. Next, we have a little example. Soriano again is preparing its budget income statement. They budget 3 pounds of direct materials per unit, $5 per unit. Read on the screen here. 0.5 hours of direct labor per unit. Labor cost $15 per hour. Manufacturing overhead at $25 per direct labor hour. Its budgeted selling admin is 12 million. So we're asked to calculate the budgeted total unit cost. So in this case, our direct materials, 3 pounds at $5. Our direct labor was a half hour at 15. Manufacturing overhead was 25 per direct labor hour. So therefore the quantity is the same at a half. And therefore our unit cost in this example will be $35 a piece. So the budgeted income statement then for this organization, Soriano, would be the 61,000,005, which is from our sales budget earlier. Our cost of goods sold would be the 1.2 million times the $35 per unit. Our gross profit. Then we have our selling admin. We're told is 12 million. So our net income before income taxes, I suppose, is $7.5 million. All right. So moving on to cash budgets and a budgeted balance sheet. So the whole point of a cash budget is to help identify the cash flows. And it's very helpful and definitely a necessity when you prepare financial budgets. And you'll typically look at cash receipts from customers, cash disbursed, or from loans, either way. No, loans fall under financing. Sorry, they do separate it here. Good. Cash disbursements, you're buying stuff, you're paying salaries, whatever that might be. And then financing, you borrowed money, you had to repay debt, whatever that might be. And so your cash budget will show the beginning and end balances. Just a little visual on the screen here, shows the ins and outs. So under the cash receipts section, it's typically expected receipts from principal sources of revenue. So do you provide sales? Okay, great. That's where it is. But perhaps, purchase returns. You bought something from a vendor to use, but then you sent it back and that's cash in. I wouldn't call that cash receipt. It's almost like a negative cash expenditure because it's part of your purchases. So when you talk about a cash budget, it looks at normal streams. Other cash receipts might include interest and dividends. Okay, sale of stock, maybe. I would still argue that's financing, but they've mentioned it here. In the cash disbursement section, that's, you're buying direct materials, paying direct labor, paying your overhead. And financing, it's any borrowings or repayments, including your interest. The cash budget, you typically prepare in sequence. You start today and move forward. You can't just jump to, month 12 or quarter 4, whatever that might be, because you need the closing for one period to carry over. Any data gathered through the budget process from management helps feed it in. So you might talk to managers to say, okay, the expense you put forward of $12 million, when do you need it? When do we spend it? And because it might not be just $12 million for a year divided by 12 months. It could fluctuate dramatically. So you want to get some of that input. And by doing so, this helps identify A, when excess cash is available, which is a good thing, or B, when cash is short, maybe you need to borrow money, maybe you have savings, a line of credit, whatever that might be. So this cash flow is super important to understand when you will need financing. So when we look at the cash budget, so let's look at the customer side first. So we have sales, and we're saying that 60% are collected in the quarter that it's sold, and 40% are collected the next quarter. So we're not assuming any write-offs in these cases. AR is 60,000 at December 31st, and expected to complete it, collected in full, in the first quarter of 2022. So a little table here shows our opening AR, 60,000. That's going to be collected in Q1. And then we've identified our sales for the 4 quarters, and that ties with the slide earlier today. And we said it's a 60-40 split. So 60 in the quarter, 40 the quarter after. So we've set up our little cash collection table. So just because we have sales of 180 in first quarter, we're only expecting cash in of 168. You can see the numbers are slightly varied. Very necessary to know. Next, we look similarly for direct materials. And in this case, we're paying 50% in the quarter and 50% paid afterwards. And our AP is 10,600. So same setup. We set up our opening AP that's going to be paid, that was carried over. We know what our purchases are by quarter, and we do a 50-50. The quarter they purchased and the quarter after. So just because we purchased 25.2 in quarter one, we actually only paid 23.2 out. So that's good. We're holding cash a little bit. So let's look at some other assumptions. January 1st, 2022, let's say we had cash of 38,000 and we don't want to get below 15. We have short-term investments expected to be sold for 2,000 during Q1. Direct labor, 100% is paid in the quarter incurred. So any direct labor. Manufacturing overhead, selling admin expenses, and they're all paid in the quarter incurred. Obviously not depreciation because that's a non-cash item, if you recall from previous accounting courses. Other assumptions, management plans to purchase a truck for 10,000 cash in Q2. We make equal quarterly installments for income taxes of the 12,000 for the year, so quarterly. And loans are repaid in earliest quarter where there's sufficient cash with the $15,000 minimum required balance. So now we can set up a little cash budget. So we had our opening cash budget, our cash balance of 38,000. The opening of each quarter is the closing of the previous. Then we can pull in our cash collections and our disbursements. Our sale of investment securities, we were told, from note 4. Gives us our total available cash. Our direct materials, we did the little table on direct labor in the period. So the budget we have by quarter is the cash budget by quarter. Same with manufacturing overhead, selling admin, the purchase of the truck, we were told in Q2. And we had to remember in the selling admin to remove depreciation, which actually there's also a part in manufacturing overhead. If you remember those slides earlier today, the selling and overhead had a depreciation component. You want to back that out for cash budgets. Income tax, 12,000 over the year, 3,000 a quarter. And therefore that'll determine what our cash balance is. So then right here in Q2, you see our cash dips below the the $15,000 mark. So we have a $3,000 borrowing required at the end of Q2 to keep our $15,000. And then in Q3, we can pay the $3,000 back, and I don't know where, but they must have added $100 of interest. Okay. They must have assumed that somewhere, or I'm misreading it. So it kind of gives you an idea what a cash budget could look like. Moving forward then is now you can create a projected balance sheet. So this is about projecting what the financial position might be at the end of a budget period. And we always start with the previous balance sheet. So we were given some information as of December 31st, buildings and equipment, common stock, accumulated depreciation, retained earnings. And so therefore we need to develop a budget balance sheet. So with the ending cash balance, if we go back a couple, 37.9, so that ties. AR, we're going to assume 40% of the fourth quarter sales, which ties in with our cash collection. Remember, it was a 60-40 split, so 40% of the fourth quarter sales. Our finished goods inventory is our desired ending inventory from earlier in the lesson, 1,000 units, $44 per unit. Raw materials, yeah, again, we had that earlier. I know it's hard to pull it all together when you're in slides. Buildings and equipment, we had the balance plus the purchase, plus the purchase, we'd had no disposals. And then our accumulated depreciation is the opening plus depreciation in the year, 15.2 and 4. Our AP, again, we had a 50-50 assumption for direct materials. Common stock, we did not talk about issuing any, otherwise it would have been part of our cash flow. And our retained earnings would be our opening plus our net income for the year. We did not indicate that we issued dividends. So our projected balance sheet then for the year, we would pull that all together and hopefully still be in balance, which we should be. because we've made assumptions on every single line item. So a little question here, expected direct materials purchases in the company are 70,000 for Q1, 90,000 for Q2. 40% of the purchases are paid in cash, the balance paid in the following quarter. The budgeted cash payments for purchases in Q2 are what? So we have some different options. So if we're looking at Q2, we'll have a balance from Q1, which says 60%. So 60% of 70 is 42,000 and 40% of 90 is 36. Therefore, our answer would be 78,000. So again, to say 60% of Q1 would carry to Q2. 40% of Q2 would be paid in Q2. So therefore, we have a balance of $78,000. So a little example then, we have our cash budget. They want to maintain a minimum monthly cash balance of 15,000. At the beginning of March, the cash balance was 15,500. Receipts expected 210, disbursements 220. So they have 65. So they need to finance for 8,500 to maintain their balance. So it's just a matter of plugging the data in from the question, and financing is the plug to balance. All right, moving on to the last section then for this lesson is about applying budgeting principles to non-manufacturing companies. So merchandisers, for example, you'll still have a sales budget. You still need that starting point and key factor. But instead of producing the materials, you have a purchases budget. So say you're Walmart, you don't produce anything, you just buy and resell. If your sales budget's 10 million, and you know that you spend typically 55 or 60 cents on your products, then you take a 55% margin, right? So on 10 million sales, you might say 5.5 million of purchases. So you look at your history, look at what's happening, and can develop a purchases budget. But it's done the same way as a production budget. You look at your budgeted cost of goods sold, plus your desired ending inventory, less your beginning, equals your required purchases. So purchases are different than what hits your financial statement. Because your cost of goods sold hits the financial statement, your purchases hits your cash flow and needed needs. So a little illustration here, 300,000 in July, 320 in August for sales. COGS is 70%. Desired inventory is 30% of the following month's COGS. Let's look at July. So budgeted COGS, 300,000 for July, times 70%, 210. Desired inventory, look at the next month, times, where was I? Sorry, 70% of the 300,000. Yes. Then we take, 70% of the 320 for the next month. They should have spelled this out. 320 times 70% times 30% to be held, 67.2. So our total merchandise purchase should be 277, less any that we started with. So therefore we'll buy 214. And this started with is 30% at the opening, assuming that we had the same principle before. Now moving on to service companies, there's a very critical factor is when you're coordinating professional staff, you need to look at, how many staff do you need to deliver services? So if you think you're going to be hired to do a bunch of consulting gigs, what kind of expertise do you need? How many people do you need? How many hours do you need? Are you hiring them as employees? You're hiring them as independent contractors, whatever that might be. And if you overstaff, you typically have high labor costs and lower profits. And turnover is more than likely because they're not going to be busy enough. They might not be challenged. But if you're understaffed, you might not be able to deliver quality products. You might lose revenues because you can't meet the need. So finding that balance in the service industry is very hard. So let's look at an example of plowing service. It thinks it'll service 300 small lawns, 200 medium, and 100 large during the month of July. It estimates direct labor hour needs 1 hour per small lawn, 1.75 and 2.75 for medium and large. And its average cost for direct labor is $15 per hour. So we can do a little table up. So we think our direct labor cost will be $13,875 based on these drivers. number of lawns, number of hours per lawn, per hour cost. Let's move on for not-for-profit organizations. It's just as important to have a not-for-profit, to have a budget, as a for-profit, and if sometimes even more so, because they're held to a higher level of accountability. They're spending donor money, federal money, grant money, whatever that might be. So they need to make sure that they have a good budget process in place to be good stewards of the funds they have under their control. Now, their budget's typically based on cash flows, looking at expenses and receipts, not necessarily revenue and expenses. So we look at, okay, us as a not-for-profit have a goal in mind. We need to figure out what's it going to cost to get there, being as prudent as possible, and then try to sort out where the revenue comes, and hopefully they balance at the end of the day. And then typically there's a fundraising team that helps, has to find receipts. So we have a mandate to deliver social services in this area. It's going to cost us $2 million. Well, we need to go raise $2 million to do so. And for government, the budget is it's strict. Anyhow, it's super strict and it can't be overspent. So if there's a budget in a government entity for $1 million, they can't go over. Okay. Versus in other not-for-profits, they might be able to go over, but that just puts more pressure on reserves, more fundraising, whatever that might be. So review question here. Budget for merchandiser differs from a budget for manufacturer because A merchandise purchases budget replaces the production budget. True. B, the manufacturer budgets are not applicable. True, because they're not manufacturing anything. So therefore, it's D, both A and B. I think the last little example here, we have Becker Company. They estimate their sales, and we're asked to prepare a merchandise purchases budget by quarter for the first 6 months. We look at our budgeted COGS. So 15,000, 80% is COGS. Adding our desired next quarter COGS, less the opening, we give our purchases, and you can follow the math accordingly. So that's this chapter, and I'll post a couple of other things after this. Thank you.